Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 74. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, just one topic for today, the madness of crowds. Everybody's familiar with that saying, the wisdom of crowds. And that essentially means that the market's right most of the time. But I think when you get to a point of mania, it becomes the madness of crowds. And maybe, perhaps, we're approaching that. I'm saying that because I'm getting a ton of inbound lately from people asking some version of this question, which is essentially, I fear that I'm missing out, that their portfolio does not have enough SpaceX in it, does not have enough semiconductors, does not have enough AI related stocks. And why do they still own things like small caps, value stocks, international stocks, and other positions? And then the question is, should they increase their exposure to things like SpaceX and other IPOs that are coming out, semiconductors and AI stocks? Should they reduce exposure to things they think that are underperforming? Should they use leverage? And really, this is the heart of it here. The fear that the bigger risk right now is missing out. And perhaps this is a revolution we haven't seen before. So why are we getting questions like this, Peter? There's only one reason, because we're at the stage of the cycle where there's just so much mania, so much frenzied activity that we really haven't seen this before, with the exception, I believe, of 1999 and 2000. I'm going to give you a few examples here. Signs of frenzied speculation are everywhere. I want your take on them. First, we have to discuss the SpaceX IPO here, the hottest in history. I just want to put some numbers out there to put this in context in terms of how unprecedented this is. Microsoft has been around for a long time. It has $318 billion in sales, $125 billion in net income. Amazon, biggest company in terms of revenue, $743 billion in sales, net income of $91 billion. SpaceX, according to their filing, had $19 billion in sales and lost $9 billion over the prior year. And SpaceX yesterday, Peter, hit a price to sales ratio of 150x. And in doing so, it surpassed Microsoft and Amazon to become the fourth largest company in the world. Your thoughts?
And I mean, think about Elon Musk. I mean, when they're writing history books 1,000 years from now, there might not be a single name, not a world leader, nothing from this era other than his name. He also has another trillion-dollar company in the top 10 in Tesla. The guy is just operating on a completely different level from every other human being on Earth. Love him or hate him, or in between, right? Where most people are. This one is crazy, though, and I think it's got a combination of the space element. Everyone has a practical interaction with it. Oh my God, I'm on a plane and I'm using this Wi-Fi that's amazing, or you understand the military contract element, or it's just the Elon Musk fairy dust, which I think is a very, very, very big part of this, along with having just such a small amount of the overall equity be sold to the public. This shatters every record, and it also could wind up being a cautionary tale in the near future, as I suspect it may become.
So what I've been saying here at this valuation level is it's essentially already pricing in an incredible future, as if it's already happened, as if there's not going to be any hiccups along the way, as if everything that people are predicting is going to happen as planned. As we know, that rarely happens in markets and with companies. There's always some problem along the way that you're not foreseeing. And the question for investors jumping in here is this going to be different than really all of the major IPOs, Peter, that we've seen in the last 15 years, where every single one of them at some point in time closed below in the following year, closed below that first trading day in terms of its closing price. The median was 50% below at some point in time. The average one-year return is 31%. We have many big names here, including Facebook and Spotify and Uber and Rivian. Many examples you can point to. Is SpaceX going to be different than these?
So many of these created hysteria when they came out. I think this is surprising to people when I share this with clients. I think they're surprised that almost every single hot IPO is trading lower 6 and 12 months later. This really is surprising to people. They feel like the IPO is the entry point, and if I don't get in here, I'm missing it. Almost always, that's not true. Almost always you wait. What the IPO is the exit point for a lot of existing shareholders like Elon Musk that have been there for a lot of the ride that want to take a bunch of money and put it in their account. The entry point for the public investor, the better entry point is almost always, not always, but almost always 6 to 12 months later.
Right. And in that next 6 to 12 months, what we're going to see is an enormous amount of supply. So we saw only 4% of SpaceX shares were actually floated in the IPO. And over the next 6 months, there's all various points when this is going to happen. You're going to have insiders being able to sell their shares, starting with their first earnings report. That's going to probably come in August. So we know it's coming. The question is, what's going to happen to the stock in between now and then? And when it actually comes, will that push it down like all of these examples in the past?
I'm not big on predictions, but I think the odds this price is going to be lower are very, very high.
Yeah, I would agree. And the idea that you're not going to be able to buy this thing at that point in time, that you have to buy it now, or you're not going to have another chance. I think it's just a very different scenario than even these examples because of the valuation that it's trading at day one. But let's talk about the semiconductors here, Peter. Another example I haven't seen since really 2000. And what I'm showing you here is the semiconductor index, the SOX, a rolling 14-month return here. So it's more than tripled over the past 14 months, up 233.3%. There's only one time period that beat that. That was heading up to the 2000 peak. It was up 233.9%. So almost there, essentially. And as you can see from this chart, this is really abnormal performance from a very specific industry group. And what we tend to see when this happens is just sentiment really chasing this one thing because the outperformance is so stunning versus everything else. If we look at the semiconductor ETF here versus the S&P 500, it almost looks comical because it's a straight line higher over the past few months. So really, a lot of this performance has come just in a very short period of time. And now we have many examples within that semiconductor index where we're seeing valuations that we haven't seen really since the 2000 mania peak. One example here, Micron, which is up 10x the stock in the last year, is trading at 21 times sales. That's more than double its peak price to sales ratio from back then. So when you see things like this, Peter, concentration in terms of investors looking at one particular industry group, does this give you any pause or cause for concern?
Well, I think whenever you have, one market technology, then a sub-market chips, and then a sub-market storage, I mean, the more specific you get, the more volatility you get. These are all in the indexes, by the way, so they're winding up in everyone's portfolios in a very overrepresented fashion. We don't really see things like this be sustainable. But it's positively impacting performance for diversified investors this year. So we'll take it while it lasts. But it's something that's just historically not been sustainable.
Sure. And the counter argument I got when I posted this chart, the counter argument is that don't you understand that there's going to be a huge increase in earnings for Micron? No doubt there will be. But that was the expectation also back in 2000 when why it was trading at an elevated valuation level. And then seemingly out of nowhere in 2000, DRAM prices crashed. You had a recession. You had things that were not foreseen. And we actually saw the price of Micron technology go down 98% from its 2000 peak. I am not, to be clear, I'm not predicting that that is going to happen. I'm just giving you an example of the last time sentiment over names like this was this euphoric. What transpired after that was something totally unforeseen by people at the time. They were only talking about optimistic scenarios, And then you almost had pretty much the worst case scenario, 98% decline. Perhaps more remarkable, Peter, is that it actually came back from that to hit record highs. Once again, it took a long time, over 20 years from that peak, but just an amazing lesson here for investors.
No, no doubt.
Let's talk about flows here, chasing performance. And we get this every couple of years. There's something that's performing so much better than everything else that money just starts piling in. This is what I'm showing you here is the DRAM memory ETF. And it just launched April 2nd, Peter. Was the fastest ever to hit 10 billion, then the fastest ever to hit 15 billion, and now it's close to 20 billion, surpassing anything we've seen in the past. Even the crypto ETFs, the ARK ETFs, nothing comes close. Why are people pouring money into this ETF? Because of performance. And just to point out, this is not, of course, a broadly diversified ETF. 3 names represent over 70% of this ETF. You got Micron, SK Hynix, and Samsung, South Korean stocks that have really helped that market this year. But 158%, it's up since April 2nd. And the S&P is up 14% over that period of time. So you have investors chasing performance just like they did. This really brings to mind ARK Innovation Fund back in 2020, 2021. In 2020, it was up 153%. The S&P was up 18%. And in early 2021, we saw billions of dollars a day going into this ETF. Fast forward to today, Peter, where is it now?
Yeah, I mean, there was so much noise around ARK Innovation Fund. I mean, I think it's pretty interesting, this new ETF. You're talking about 5 companies making up almost 90% of it. They've got to be high-fiving themselves over there for whoever's idea it was to put 5 companies together and collect management fees on a subsector of a subsector.
Yeah.
Just absolutely unbelievable. But I think we're going to see the chart look very similar to this at some point over the next few years.
Yeah, it's hard for investors to understand this, but I think it's pretty important. You don't, in buying the thing that's already run, you don't get that prior performance. So what I would hear from people back in 2021 was that, hey, this thing was up 100%. Even if it's up half of that going forward, I'm going to do pretty well. That's not the way things work. You don't get that extreme performance. More likely you're likely to get reversion to the mean. It doesn't have to crash like ARK, but the idea that 150% over a 2.5 month period is normal or sustainable, definitely not. And I've never seen, Peter, I've been following markets and funds for a long time. I've never seen money chasing performance like this after the fact have a good outcome in the end. That doesn't mean the next month or two, it could get even crazier. But I think for most of these people chasing these things, they're going to have a return that's much, much worse than their initial expectations. And if they're like most of these examples, they're going to be dumping these things at lower prices eventually. They're going to capitulate. So as you often talk about, the average performance in terms of the ARK investor, much worse than what even the returns have been because they bought at the worst time.
Yeah, we saw this, you see this over and over again with managers like Legg Mason Value beats the market 15 years in a row. Most inflows go in then it collapses. So more people suffered the bad side than the good side. We saw it with Paulson's hedge fund. One of the best performing hedge funds made a huge market call around the 0809 crisis. Huge amount went in, made a very, very bad bet. The majority of people in that fund have lost an enormous amount of money. So you look at these historical returns of funds, money comes in after one catches a streak. Usually the same things that coalesce to make things perfect become undone to make it less than perfect, and you see the collapse. And there's always more investors captured in the downside than ever participated in the upside.
So let's talk about what to do here, right? That's the question. What I would argue is it's a time for prudence. That doesn't mean the market can't keep going higher in terms of the overall market. We've talked about the earnings story, and there's a lot of good fundamental drivers. But in terms of when you want to take risk, when you want to play offense, Peter, you want to play offense when everyone else is scared and running out of the markets. That is not this time. And so I want to just lay out a few points here related to this that people should keep in mind. Number one, in terms of missing out, if you have a diversified portfolio, this has been an incredible decade for you. The last 10 years, the S&P 500 has more than quadrupled. It's up 15.7% per year. It's hard to explain to investors how unusually good this is.
Right. I think that like people don't realize that the best performing portfolios have been heavily equity based diversified portfolios. They've captured all of the craziness that's been happening. When the US outperformed, you did well. Last 18 months, international's outperforming, you're doing well. Mag 7 went on a big tear. Everyone wants more of that, but this year it's underperforming, but everything else is doing well. So the diversified equity investor, it's really been a grand slam for them over the last decade versus placing a bet, in any of one of 10 places. Yes, some of them work out for some periods of time, but the real play has been stocks over bonds, especially in the last couple of years, and tilting more US than international over the decade.
All right, let's talk about number two here, because this is a question I get in many different forms. People feel they don't have enough exposure to technology or AI. And we're at a point, Peter, that we haven't seen before. The tech sector is more important in terms of the US market than it's ever been. And there's good fundamental reasons for that in terms of earnings, but almost 40% of the S&P 500 is now in the technology sector. Back in March 2000, it peaked at around 35%. So if you dig through your diversified portfolio, you're going to see, and it's not just tech, as we know, there's many other areas that are benefiting from this as well, but you're going to see that you probably have way more exposure to this than you think.
Yeah, I think people are surprised to see like that. You think you own, I own an index, and so I own 10% of this and 10% of that and 10%. It's not how it is at all. I mean, the largest position in a diversified equity portfolio right now is technology. The largest share of a diversified portfolio technology has ever had in the stock market history. And so the tech run is contributing a great deal to what we've seen happen in the markets over time. Yes, other industries are having their day, financials, energy, throughout the decade, but technology has been a persistent theme, and it's become a very, very big weighting. Now, I think it's justified. I think that concentration is justified. The world is becoming increasingly dependent on technology for growth and for advancement. So it makes sense that it's becoming a bigger and bigger part of the pie. But don't ever feel like you're missing out. A very, very big part of a portfolio is tech.
And I think this is lost on a lot of people,
Yeah.
given the mania that we've seen in semiconductors and what's going on in SpaceX. That diversification hasn't actually even hurt you this year. It's helping you across all of the major equity market factors. Got emerging market stocks up 23%, small caps 19%, value stocks 15%, mid caps 15, international overall around 14%. S&P's having a great year, it's up 9%. But look at growth stocks, 3%, and the Magnificent Seven ETF is actually down on the year.
I mean, we had to do a whole episode around why don't I put all my money in the Mag 7 a year ago almost. And for it to be negative while everything in the world is positive is just shows you how things can change, how fast they can change.
We're seeing a massive rotation, and I don't know what to make of it at this point. Even within the Mag 7, it's become really the Mag 2 with Google and Nvidia. The rest of the names have underperformed over the last 18 months now, underperformed the market. And then even within tech, Nvidia is not the hot name anymore. It's shifted into things like Micron and other areas where we're just seeing more speculative activity and more performance, and investors are chasing that. So there's a narrowing in terms of the speculative names. It's interesting to me that the old guard here, in terms of what brought the market, what lifted the market a lot over the last decade, is now underperforming. That's not to say that's going to continue, but I think that's pretty fascinating to see this year.
Yeah.
Let's talk about what's the bigger long-term risk here. Missing out, which is what people are asking about. I realize, making a change to my portfolio is going to increase the volatility, increase risk, but is the bigger risk missing out on those gains, or is it following the madness of crowds. And I want your take on this, Peter, because this is really what investors need to hear right now.
So what I've seen from our wealthiest clients, over my decades doing this, is they know if you swing for the fences, you can strike out, right? And so one of the keys to investing is to just never get knocked out of the game. You want to be winning almost all of the time. You're not going to hit the ball every single time you're at the plate, but you really, really want to avoid permanent loss. The diversified investor, this is a case study, right? Mag 7's negative this year. Everything else is positive. International emerging markets positive this year, last year, much more so than the US. What we thought was really hot, which is US big tech, that's now negative. Many of those stocks in the Mag 7 are negative, but we're seeing a rotation to another segment of tech. It's just very hard to be in the right place at the right time repeatedly. So the key is diversify, focus on the asset class decision, more stocks than bonds if you want to focus on growth, maybe private investments that are equity oriented if you're focused on growth. Spread your bets the way a wealthy family does, a wealthy investor does. You wind up in the winner's circle almost every single 5-year period in history. You do that over and over again, you win the person that you beat the person that's trying to find the right spot at the right time throughout the year all the time.
And really avoiding that concentration risk, as tempting as it is to be concentrated in the thing that's doing better than everything else. That's really what can really hurt you. That's where you're going to put a big dent in your portfolio if that goes wrong. So what should you do? You should stick to your long-term plan. And Peter, you and I, when there's crashes, corrections, we're out there like you were in April 2025 during the tariff bear market, counseling people to stay calm and stick with your long-term plan. That's an important job for an advisor. But equally important, I would argue, is to give that message today when people are losing their minds in the opposite direction. They feel like they're missing out.
Yeah, I think part of it's knowing where to put your money, and part of it's avoiding the concentration risk that can blow things up. I think this has just been an incredible year, this year and last year, of how the person that's got some bet spread really is going to win over the long run. I think we're going to see there's lessons in motion now. I think that SpaceX, one of the greatest leaders and greatest companies and greatest ideas ever, several things can be true at once. Elon Musk can be brilliant, the company can be amazing, and it can be overvalued. I think we're going to see this lesson play out in real time. No guarantees over the course of this year and next as well, just as we saw with the Mag 7, just as we've seen history show us over and over again.
Well said, Peter. So let's plan on revisiting this in December as we do our year-end review. We'll look back and see if this was a time to be prudent and to keep these lessons in mind. If you're watching this thinking about your own portfolio, what to do with all of these IPOs, with this mania in semiconductors, everything, we're here to help with that. Reach out to us today at creativeplanning.com/Charlie. We'll look at your portfolio, your plan, make sure you're on the right path to financial independence. At Creative Planning, we're in all 50 states. We're abroad as well, international. So reach out to us. We have over $700 billion in assets under management and advisement, and we're here to help. Go to creativeplanning.com/Charlie. I'll have a link in the show notes. Great show today, Peter. Fun discussion. If you're watching this on YouTube or Apple or Spotify, hit that subscribe button for all the latest content from us. And Peter and I will see you next time on Signal or Noise.